Welcome to Wealth from Walls, the monthly podcast show dedicated to empowering and safeguarding home buyers and investors in the pursuit of wealth creation through property. Join us as we provide expert tips and strategies in finance, law, and property to assist you in achieving extraordinary success in your property journey. My name is Amir Sehat, and I am the Director of Project BT Property. I am an independent property advisor who utilizes data to analyze property market trends and streamline property acquisition. And today we will be talking about latest updates on the property market, including interest rates. We'll also explore tax minimization strategies for property investors and common mistake to avoid. But before that, let me introduce you to my peers, Mohit and Melissa, and also our guest, Warren Parker. Melissa Barlas is the director of Conveyed and brings her expertise as an experienced property conveyancing lawyer. Mohit Pachauri is the co-founder of his mortgage broking business called Capital for Castle. And Warren Parker is the director of HeadStart Tax Accounting with extensive experience in accounting services. Warren, thank you very much for joining us today. I'm confident that your insight on taxes for property investors will be incredibly valuable to our audience, especially during this time when everyone is talking about tax.
Thanks for having me, Amir, and I'm excited to be here this morning.
Appreciate it. So let's dive into the discussion. Mohit, what are the latest updates in the finance world, mate?
Well, the latest update when all the mortgage borrowers on Tuesday took a sigh of relief when RBA said, you know what, this month we're going to put a pause. We're not going to increase the rates. So happy days. Now, the market expectations were quite mixed prior to this because inflation did go down a little bit late last month as per the records. But some were saying, there's still 2 more rate hikes on the card because the inflation is not quite where it needs to be. Some were saying, I think it's going to be paused. So the ones who said paused, it is paused. Now, what's going to happen? The post-meeting statement on monetary policy, RBA said that the pause would provide the central bank with some time to assess the impact of the increase of the interest rate to date, because it does take a few months for the inflation to be adjusted when the interest rates or the cash rates rather doesn't change. But needless to say, I think there is more tightening is still expected to bring the inflation back to the RBA's target.
Exactly.
So the borrowing market is still quite challenging, which brings me to the second point regarding self-employed clients. Now, self-employed people, they have seen quite a rough time going into the COVID and coming out of it as well. So lenders recognize that, and some of them are becoming quite lenient with their policies. So what latest we have is that if you are a self-employed person paying yourself a regular and consistent salary, and if that salary is sufficient to service the loan, lenders do not require to see your business financials. They don't require to see your business performance, tax returns, which means all your business commitments, liabilities, they can be tucked away. And they will purely analyze your borrowing capacity based on the income that you're drawing. Now, this works for a lot of businesses because everyone structure their expenses, their incomes differently. Which sort of brings me to the point to lead into Warren that when we do talk about buying an investment property, the main questions we get asked is, how am I going to save tax? What should I do to minimize tax returns? And how can I build wealth while reducing tax? So it's a very gray area, isn't it? That should you be looking at reducing tax? Because if you reduce tax, which means your income is less, which means your borrowing would be less as well. What is the right strategy, Warren? What do you think is the right answer?
So I think it depends on the client and it depends on their particular circumstances, but I don't tend to agree 100% with just go and buy a rental property. It's going to gain wealth. It's going to gain equity over time, and you're going to become wealthier because of that. Because the issue that you have is that negative geared properties, which a lot of them are in this market because of the prices and the rental returns, a lot of them need cash flow. So if your cash flow, if you have disposable income of, let's say, $500 a week, and that property is costing you $400 a week, how many properties can you actually buy? You can only buy one property. So it does decrease your cash flow by $400 per week. But if you are claiming then $400 a week as a tax deduction per se, I know that that's not necessarily the case because of interest. You're only claiming interest, not the repayments. But let's just say it was $400 a week. That works out to about $20,000 a year. You're physically paying $20,000 to get, if you're on a tax bracket of 32%, you're going to get $6,400 back at tax time, but you've paid $20,000 to get that.
Exactly.
So sometimes it doesn't really make sense. I do have a bit of a joke with my clients: give me $20,000 in accounting fees and I'll give you $6,400 back. And they all have a bit of a laugh about that, but that's what it is. So I think the other part to it is, when it comes to you, Mohit, you see people's financials and their income. Now, if their income is not high enough to borrow more money, well, then that hurts them as well. So we've got to keep the cash flow. I believe you've still got to keep the cash flow up to build your wealth. So I don't necessarily go and tell people to buy cars at the end of the year or anything like that to decrease their taxable income, because that doesn't necessarily help them build wealth. If they need those items to reduce their tax, and it is a part of their expenditure for their business or for their personal income, well, that's a different nature. But you need the expense rather than want the expense to get a tax deduction. I think there is a significant difference there. So I would prefer people to be paying a little bit more tax, because I think the more income you earn, the more tax you pay. In proportion, you're never paying more than 47 cents in the dollar in tax. So you're always actually adding money into your pocket. So I think building your wealth, the best way to do that is to be generating more income rather than to try and manipulate things so you get more expenses. I hope that all makes sense.
Does.
Absolutely makes sense. Warren, you made fantastic points about taxes not always being the most important factor for property investors. I understand, it may be tempting to focus only on tax savings, but there are also other important things to consider when buying a property. Many investors are attracted to new properties and house and land packages because they offer significant depreciation deductions. And they believe that by claiming depreciation, they can save, as you said, around, for instance, $5,000 or $6,000 in the first year alone, and turn their cash flow from negative to positive. Look, I get it. New properties and house and land packages offer attractive tax savings, but property investing only for tax saving is not ideal at all. The key objective of investing is actually wealth creation, not tax minimization. And although tax savings are beneficial, it is important to evaluate the overall potential of a property, including long-term growth and rental returns, before making any sort of decision. So yes, of course, house and land packages and newly built properties can provide opportunities for depreciation claim. And yes, you can save a bit on stamp duty, as you only pay stamp duty on the land component. And yes, you have lower maintenance costs. I get it. But the properties, these type of properties generally have less potential for capital growth and rental income growth compared to existing properties in solid suburbs. Mohit, I hear you asking why. Well,
Why?
the reason is that these, when it comes to new properties, they are typically located on the outskirts of the city, where infrastructure and economic development may be lacking. Okay, reselling properties in these suburbs can be challenging because of high supply and low demand, which can significantly impact the selling price. You know, it is just not as promising for capital growth compared to more established areas where demand is higher and supply is lower. When it comes to investing, it is common sense to look for properties with good amount of land. Land is what really drives up the value over time. But the new properties in developing suburbs, in those type of properties, most of the value is in the building, not the land itself. So you might not see as much appreciation in value compared to properties in established suburb where land is more scarce. Also, new properties don't offer as much potential for adding value through renovations or development. You can't really do much to increase their worth. It is different with older properties in established areas where you have the opportunity to make improvement and boost their value. Another thing to consider is that rental properties in developing suburbs tend to have higher vacancy rates, and it is absolutely impacting the cash flow, as Warren mentioned. They are not just as attractive to tenants, especially when there are plenty of other rental options available. So what happens is that landlords end up competing with each other, and they offer discounts to attract tenants, which can limit rental growth and make it harder to earn consistent rental income and make their cash flow poorer. So the truth is, investing in a new property might seem appealing initially, but it often falls short in the long run. That is why opting for an existing property in a solid suburb, despite lower depreciation deduction, can be a smarter, longer-term choice.
I hear what you're saying, Amir, because a lot of people get enticed by the idea of buying something new. And sometimes there's you might come across developments with really good marketing tactics that say zero stamp duty because of the reduction in the dutiable value of the property when you deduct the construction costs off the base price. So a lot of people sort of can get enticed by that and start to buy new. But as you pointed out, that's not necessarily the best for capital growth over time, which is really important to know. But also when you are buying in more established areas, or even if you want to buy something that you want to renovate to improve or to appreciate the price over time, to appreciate the value over time, you've got other stamp duty concessions available. So, you know, if you're a first home buyer and you want to buy an established property and it's valued up to $600,000, you get a full exemption. Or even if it's valued up to $750,000, and there's a lot of established houses or units out there that do fall within the $6,000 to $7,000 mark, and you still get a stamp duty concession on a sliding scale within that price range. Obviously, you need to meet certain qualifications, but you know, just in a general sense, if you're a first home buyer, you do get those concession entitlements. So that's something to look into as well. And there's obviously changes with the budget that's come out with the government with regards to stamp duty applicable to pensioners. Now, that's a specific demographic, but they've also increased the dutiable concessions available for anyone that holds a pension card, even if it's a disability pension card, where if you're going into the property market to invest, if the value of the property is up to $600,000, you also get an exemption. It used to be less. I think it was up to about $300,000 or $330,000 where you'd get a full exemption up to. But now they've followed the first home buyer rules, so to speak, when it comes to the value, where if you hold if you hold an approved pension card, then you can get a full exemption if the property is valued up to $600,000, or the sliding scale concession if it's valued between $600,000 to $750,000. So you do have those tax benefits as well in the capital cost. But one thing to bear in mind is it's not stamp duty and getting concessions on stamp duty shouldn't form part of your overall strategy for minimizing tax, if that's still, you know, a strategy that you're interested in, because it does come off the capital costs. It's not something that you get the benefit of on an ongoing basis. So, Warren, for those that have a property or want to invest, and because we're at a time of year where people are doing their tax returns, what sort of documentation, in the context of owning property, what sort of documentation do people need to provide when it comes to lodging their tax returns?
Yes, so there's a couple of different categories here, and the categories are, like, obviously if you've just purchased a property or if you've sold a property, but also if you have an ongoing rental and an ongoing investment. So when you purchase or sell a property, what we would request is the contract of sale and the settlement documents, but also if you've purchased a property, the opening bank statements and any other on costs that they might have. It could include legal fees, so your fees, Melissa, because these fees generally form part of what's called the cost base, which is the cost of the asset. It's not a running cost. So the running costs are like the rental property running on a day-to-day basis. These form part of the cost base. So when you buy and sell a property, you have a cost base, and then when you sell it, you have like a sale price. So the difference between those, you pay capital gains on. So these form part of the cost base and actually increase the cost base. So we want to make sure that we get all those costs involved in the cost base, so we're not missing anything. But then, so after that, the initial purchase, then it would be things like a real estate agent summary. If a lot of people have real estate agent summaries, we would get that. A lot of real estate agent summaries, they don't pay for things like interest though. So we need bank statements and things like that so we can get the interest for the year. They don't generally pay council rates, water rates, insurance, things like those, and body corporate fees, things like that. So they can pay everything. Real estate agents and property managers, they can pay all of them, but generally speaking, they don't. So you get the real estate agent summary, and then you have to add on everything else that you've paid outside of that. So that could include advertising for tenants, but generally that will come under the property management, body corporate or strata levy fees. We can also claim borrowing expenses. So when you purchase the property, you might have borrowing costs on the bank, from the bank. So they might charge you an annual fee or something like that. So we can have some of that. Cleaning fees, council rates, depreciation and capital allowance. So depreciation is on the bricks and mortar. So it's actually on the building. And then you have capital allowance, which might be on assets. So I think before Amir mentioned the depreciation report. So when we have a newer property, or pretty much any property with inside 40 years old, we say to the client, have you got a depreciation schedule from a quantity surveyor or a depreciation expert? And we claim those expenses as well. Now, one thing you've got to note is when we're claiming the capital works, that does come off the cost base. Even if you don't claim it, it actually comes off the cost base now. So there's been new rules put around that over the last few years. Then there's also gardening, insurance, interest, land tax, which is another form of tax there. Legal fees, if there's anything involved there. Pest control, agent fees, repairs that you do to the property. That is a big grey area for the tax office. That is something that they want to look at very regularly, and generally they come out and talk about what they're going to look at for individual tax returns and stuff every year in June. That is one that comes up all the time, because what people do is they'll have a fence. Let's use a fence as an example. And they have a fence that falls over totally. Now, if you rebuild that entire fence, that is not a repair now. That is a replacement. So you've got to depreciate that fence over the life of the fence. But if you have the fence and 3 or 4 palings come off and you replace them and just repair those and don't repair the whole fence, that is a repair. So the same thing happens with painting a house. If you just patch up one room, that's a repair. If you go and repaint the whole house, that's not a repair any longer. So that is a really grey area, repairs versus capital improvements. So that is one that the ATO spotlights every year. Then you have things like just stationery and things like that. Travel, you used to be able to claim travel to and from a rental property to do like gardening or cleaning or things like that. You can't claim that anymore. Just full stop, no travel. So people have overclaimed in the past. So now the ATO have said no travel. Water rates, and then just any other thing related to that rental property, to be honest. So if there are other things related to that rental property, we can claim. So just going back on talking about rental property owners, there is a stat that came out from the tax office, I think it was maybe a month ago, so in June, that pretty much said that 9 out of 10 rental property owners have got their tax returns wrong in the past 12 months. So that is a massive amount, 90%. And I think a lot of it does come around the repairs and maintenance and capital allowance areas. So I hope that has given you a bit of an idea that we really need good record keeping. So you need to create yourself a good record keeping system in order to maximize your tax deductions, and obviously see a professional as well to get a depreciation schedule, a quantity surveyor's report. And I know that you guys all have access to those types of people. So definitely recommend your clients to go and seek advice and ensure that they can maximize their claims.
Sorry, I was just going to ask a quick question to Warren. So in order to keep the records as clean and as accurate as possible, do you recommend that every time someone buys an investment property, you get an investment property loan, you get a transaction or a separate offset account attached to that investment property home loan? So all your income goes in that account, and then all your expenses are done from that account as well. That way, at the end of the financial year, you get 12 months of summary, and then you can clearly see how much has gone in, how much has come out. Do you reckon that's a good recommendation?
If it's just a single bank account that everything comes in and out of that is the rental property, I think that makes sense. I think that could work quite well. Yeah, but everyone is different because, you know, for me, if I prefer, if I have a principal place of residence, I prefer the interest to be going down on that rather than on my investment property, because the interest is tax deductible on my investment property, whereas on my primary residence, it's not deductible. So personally, I'm doing everything I can to reduce the interest on my primary residence rather than my investment property.
100%. So we just keep the investment property loan and the account associated with it completely separate to your principal place of residence.
100%. Don't mix them, because once you start mixing them and once you start putting things in and out of that investment loan, then it becomes, again, a really gray area. And for instance, if you take out anything from that investment loan that is personal, then it's what's called tainted. It's a tainted loan. So it's no longer 100% deductible because you've got private use in there.
Fantastic points. We talk about a lot of important issues in tax minimization strategies for property owners and property investors. But before we move on, Warren, can you please also give us some hints on selecting the right structure for property investors? Because as you mentioned, tax minimization is not always the best strategy for all the people, and certain type of clients might look at, for instance, asset protection. So how does selecting the right property help these type of clients?
Yeah, so tax structuring for property investment can be a little bit tricky. Number one is what people want when they structure either their business or investments is that generally they want two things. They want tax minimization and they want to protect their assets because they go into business or they're buying property to make money. So what happens after a few years of making money? You want to increase that wealth. So you keep going down that path. So they're obviously about building their wealth. The other thing that's got to come into consideration when you're looking at a property portfolio is the way that capital gains are structured. And the reason for that is because with properties, generally speaking, and Amir, you would have a lot more stats than me on this, but generally speaking, the properties double in value every 7 to 10 years. I think that's probably a broad generalization.
Yeah.
So obviously there's going to be capital gains down the track at some point. So I think you've got to take that into consideration. So generally the three options are, well, there are four options: self-managed super funds, which I don't really deal in. So that's a different scenario. So then you have a company structure, a trust structure, or through your personal names. Now, client to client, it is different because it does depend on what their partner is doing as well. So if you have a husband and wife team where both of them are running their own business and there's risks of being sued or something like that, well, then it's probably not great to have properties invested in either name. Other than the main residence is a different thing. The main residence, you always need to invest in an individual's name if you want the main residence exemptions. So what that means is that the main residence that you live in, if that is your principal place of residence, you are exempt from paying capital gains tax. So that's why we have that in an individual name. In regards to investment properties, tax is payable on the capital gains. So whether it's in an individual name, a company name, or a trust name, you need to pay tax on the profit that you make from the sale, less what you bought it for. So the three options are a company. So a company, the pros are that it increases your asset protection. I suppose the negative is, in today's market, a lot of assets, a lot of property is negatively geared. So if you have a new property and you're maximizing the borrowing, you're generally going to have a negatively geared property. With a company, losses don't come out of the company and you can't claim them. So they sort of get stuck there until you make profits down the track. So if you're looking to maximize the losses and claim those losses, you can't do it through a company. So that probably is one of the negatives there. And then again, there is a cost factor to set that up. With trusts, in regards to go back to company for 1 second. In regards to capital gains with companies don't get a 50% discount on the sale. So they actually pay capital gains on the full amount, your sale price less your cost price. They pay tax at the company rate at the moment. I think it's 30% for passive investment. So if in that company you only have a passive investment, you're paying 30% tax on the full capital gain. If you have a trust offers a little bit more asset protection again than a company. So it is increased. In regards to the tax minimization strategies, it does have some issues around distributing losses as well. A trust can't distribute losses as well. So if you're looking to utilize negative gearing, you can't really do that in a trust. And with the capital gains, a trust does get a 50% discount after you hold it for longer than 12 months. Same as an individual. Individuals get the same. So if you make a capital gain of 700,000, a trust then only pays tax on 350,000 at normal marginal rates. Whoever it is being distributed to, it pays at their marginal rates. Even if you leave it in the trust, the highest rate that the trust will pay is 45%, But if you halve that, it's still 22.5%, which is less than a company, which is 30%. And then you go to the individuals, and the individuals, the worst thing about investing in individuals' name is the asset protection. There isn't any. So if you get sued, that asset is at risk. The thing that you can do to create some asset protection, this is what I was talking about before, each individual is different, and each client is different and has different needs. But if my spouse is just a normal pay-as-you-go earner, there's not much risk associated with what they do, then potentially you could invest in just their name. Okay? Because if I'm running a business or I'm at risk, then I'm alleviating some of that. People are going to sue me, but the asset is not in my name. So you can do some asset protection in that manner. And also the other thing you've got to look at, that's asset protection part, but then the tax minimization. If we're looking at the same thing and I'm the business owner and my wife's a stay-at-home mum, I might be on the higher marginal rate, she might be on zero. So you want to minimize the tax by giving it to me because I get a greater tax deduction. So again, each individual client is different. I just explain the situation to them. Are you after asset protection or you're after tax minimization? So it is a really difficult thing there, but I'll leave it up to the client at the end of the day. I give them all the information and all the advice, and you know, I might make suggestions and recommendations, but at the end of the day, they're going to go away and choose whichever way they feel more comfortable with, I think, in that aspect. So I hope I've answered all of your questions there, Amir.
Very, very complete way. Appreciate it. Thank you very much, Warren. You shared very valuable information to all of us, and I'm sure that our audience learned a lot today. So thank you everyone for joining us today. Thank you for sharing the information. This is all from us today. And if you have any questions or any particular topic you'd like to us to consider, please drop us a line and we will see you early next month. Till then, stay warm and keep safe.
See you guys.
See ya.